Which has more potential, Bitcoin or Ether? I don't really like this question that much, mainly because I view them as fulfilling fundamentally different purposes. I hold both in my portfolio, and I'm bullish on both. However, it's an important question that many of you are no doubt asking. It's especially relevant for any of those who are relatively late to crypto and are looking to max their gains. So that's exactly what I'm going to explore in this video. I'm going to try and analyze the short to medium-term price potential of both BTC and ETH. I'll be taking a deep dive into market dynamics, protocol upgrades, and fundamental shifts. All of that is to try and help answer this vexing question. Oh, and I do have an updated price prediction for both, so be sure to watch to the end for that. Before we proceed, we need some legalese. Despite what those voices in your head are telling you, I am not a financial advisor. Don't listen to them. Therefore, everything that you're about to hear in this video can only be considered educational. Do your own research. With that dose of reality out of the way, I would like to welcome anyone new to the channel. The name's Guy, Crypto Guy, and I'm the top agent here at the Bureau, providing you with top-secret content that's shaken, not stirred. If that's the type of content that could quench your thirst, then be sure to subscribe and to turn on all those notifications. That way, you can be certain my future videos don't fall through YouTube's cyber cracks. Timestamps are also provided in the timeline right here. Those are there for your convenience should you wish to jump around, although I do encourage you to watch as much as you can. Alrighty then, let's get down to business. Firstly, let's start off with a bit of price analysis. Both Bitcoin and Ethereum have seen some impressive gains over the past 2 months. They have both broken through their previous all-time highs from the 2017 bull run. The only difference is that Bitcoin broke through its previous all-time high, or ATH, in December of last year, and ETH only managed to crack that chestnut in early February. Moreover, the experience since then has also differed for BTC and ETH. Bitcoin continued its parabolic rise such that it's currently sitting at over 190% above its previous ATH. Ether, on the other hand, has had a more measured appreciation and is currently only 44% above its ATH. Now, this is of course important for a number of reasons. Firstly, you need to consider that profit-taking will take place. While there are some investors who would like to hodl for the long run, there are many others that would like to strategically take profit at certain levels. While nearly all Bitcoin and Ethereum wallets are in profit, you have relatively more unrealized profit in the Bitcoin wallets than you do in the Ethereum ones. You can take a look at a number of these metrics over at glassnode.com to further confirm this. What this therefore means is that Bitcoin hodlers are more likely to take profit at these levels than your Ethereum hodlers. Of course, as we know, when there is any sort of profit taking, this could lead to selling pressure. It's also important to take a look at the market psychology of these relative levels. If you were a new investor and were trying to choose between two different investments, that which is 30% above its ATH appears relatively undervalued compared to that which is over 190%. Now, of course, while this may be a simplistic way to view value, it's how a lot of newbie investors are likely to perceive the market. One could be viewed as overvalued based on historic levels. So, this newbie buying pressure is likely to be more ETH-centric. So, that's relative historic value. But let's take a look at relative value across the space. One of the most important metrics studied by market analysts is Bitcoin dominance. This is a measure of the percentage of all crypto market cap that is taken up by Bitcoin. So, when the BTC dominance is falling, it means that there is a general market pivot away from Bitcoin into alts, more colloquially known as alt season, baby. Anywho, here we have the Bitcoin dominance over the past few months. As you can see, there has been a sustained fall since December. We went from just over 72% to 62% today. So altcoin performance has been relatively stronger than Bitcoin's over the past 2 months as investors have started dipping into these waters. Now, of course, even though this dominance has been on a downtrend, we cannot ignore the fact that alts do follow Bitcoin. If Bitcoin is rallying, they will follow. If Bitcoin shits the bed, they will too. This is because Bitcoin and altcoins are quite highly correlated. They statistically move together. As the largest altcoin in the space, Ether is also susceptible to this. So any sign of a reduction in the correlation between BTC and ETH would be a good sign at least. It could mean that Ether is going through a Bitcoin decoupling. So how is that correlation looking? Well, here we have the BTC ETH 6-month rolling correlation. As you can see here, there has been a sustained decline in the correlation over the past year. In May of last year, it stood at 90%, and it reached an all-time low of only 60% at the time of shooting this video. So it appears as if ETH is slowly decoupling from Bitcoin. Yes, it's still a positive correlation, and ETH is still likely to take some cues from the Bitcoin price. However, it's nowhere near as strong as the 90% we were experiencing less than a year ago. So let's put this all together. ETH is relatively cheaper based on its ATH versus Bitcoin. ETH addresses have less unrealized profit than Bitcoin addresses. Newbies are more likely to think there is more potential, rightly or wrongly. We seem to be pivoting to alts, and ETH is decoupling from BTC. From a pure market perspective, it does appear as if ETH has more short to medium-term upside potential. However, the markets are but only one consideration. We need to take a deeper look at the investor profile of both cryptocurrencies. It's been the predominant theme over the past year, the large-scale mass institutional adoption of Bitcoin by institutional investors, from hedge funds to companies, mutual funds to high-net-worth individuals. They've been hoovering up Bitcoin like nobody's business. In fact, this was something I covered in my video on corporate Bitcoin adoption back in October of last year. Since that video, the adoption trend has only just strengthened. Indeed, the massive rally that we've seen in BTC since then has almost exclusively been driven by this investor class. Now, of course, the most important question is whether these institutional players are also considering ETH. Are they looking to diversify their Bitcoin holdings and take advantage of the premier developers blockchain? Well, there are a number of things we can look at to get a sense of this. One of the go-to metrics that most analysts tend to look at is the amount of ETH that is held by the Grayscale Investment Trust. For those who don't know, Grayscale is the largest crypto trust company in the world with numerous different funds. So over here we have the total amount of ETH that is being held in the Grayscale ETH Trust. You will notice that it was steadily increasing up until December of last year. However, ever since the 8th of December, Grayscale put a hold on the purchases. Then, on the 1st of February, they opened the gates again and the funds rolled in. On the first day of acceptance of new funds, they purchased a full 52,000 ETH. And since then, the trend has only been in one direction. Since the 1st of February, the amount of ETH held in the Grayscale ETH fund has increased by almost 7% to 3.1 million. Just for comparison purposes, let's pull up the Bitcoin Trust holdings. You can see here that it increased from about 648k BTC to 655k BTC today, a 1% increase. So that's interesting. And it's not just into Grayscale products. In fact, according to a report by CoinShares, in the first 2 weeks of February, inflows into ETH products accounted for a full 80% of all crypto fund inflows. They stated, quote, "We believe investors are looking to diversify and are growing increasingly comfortable with Ethereum fundamentals." It's also worth pointing out that this coincided with the introduction of the ETH CME futures on the 8th of February. In the Ethereum video I did in January, I mentioned this as one of the institutional catalysts that may supercharge ETH. Many were worried about whether this could lead to a similar experience of Bitcoin's price post the BTC CME futures launch in 2017. But, as I predicted, it was the opposite reaction. Anyway, the first week of ETH CME futures saw a sustained increase in both open interest and volume. Institutional investors were flocking to the futures market in droves. So, what this shows us is that these institutional investors are starting to pivot. While they will no doubt still hold Bitcoin as a primary asset, they are looking to diversify into alts and, more specifically, Ether. And if the institutional craze that we saw over the past 4 months for Bitcoin were to play itself out in the ETH markets, the price could be ready to skyrocket. Yes, there are still oceans of capital in fiat land that are likely to want to first invest in Bitcoin. But, and this is an important point, it's a lot easier to convince an institution that has already bought Bitcoin to buy ETH than it is to get a fiat-only no-coiner fund to buy their first Bitcoin. Okay, so it's pretty clear that ETH could be poised for some heavy institutional investor demand. However, there is a whole other side to this demand equation, and that is through utility or network demand. So, let's take a look at that, shall we? When you buy Bitcoin, why are you doing it? I'm sure that the vast majority of you did it in order to either grow your wealth or protect it from inflation. Indeed, this is the same rationale that has been used by all of those institutional investors I just talked about. Bitcoin is seen as a store of value, a digital gold that funds will buy and move to cold storage to be hodled long and hard. Some may use it as a medium of exchange, but it's no longer really thought of as the digital cash it once was. Therefore, Bitcoin's utility demand pales in comparison to its investment demand. When it comes to Ethereum, however, it's a whole other kettle of fish. As a developer blockchain, the Ethereum network has seen an explosion in demand. This has become particularly acute thanks to the exponential rise of DeFi over the past year. Indeed, the unsustainable gas fees that we're seeing on the Ethereum network right now demonstrate just how much network demand there is. From stablecoins to lending protocols and decentralized exchanges, the ETH ecosystem is in overdrive. Take a look at this ETH transaction graph over here. As you can see, transaction volume has been on a sustained rise over the past year and is now at all-time highs. All of this network use, of course, leads to demand for ETH. Not only is ETH often used as collateral in many of these protocols, but gas fees are also paid in ETH. As we know, gas fees have been sky high recently. And I happen to think that this trend won't see signs of slowing down. DeFi is heating up and stablecoin demand is taking off. Yes, there are competing blockchains and projects which are trying to capitalize on ETH congestion, but ETH 2.0 is being worked on at a feverish pace. We also have the implementation of EIP 1559 that could bring more predictable fees to the Ethereum network. More on that in a bit. If ETH 2.0 really does live up to what it's hyped up to be, then it really could be that global decentralized computer it was meant to be. When it comes to Bitcoin, I don't think we will see much more utility demand coming online anytime soon. Yes, the Taproot update could see more smart contract functionality brought to the Bitcoin blockchain, but it will be quite elementary when compared to the functionality on Ethereum. So, from a demand perspective, Bitcoin appears to be used predominantly as an investment. However, Ether appears to be coming not only from that increased investment demand, but also from extensive utility demand which shows no signs of slowing down. And as we know, with a stable supply, increased demand means an increase in price. However, that assumption is based on the notion of stable supply. But supply is anything but stable. One of the main reasons why people think the Bitcoin supply schedule is more favorable than Ether is because of the 21 million supply cap. They state that the lack of a max supply on the Ethereum network means that inflation is likely to place downward pressure on the price of ETH. The only problem about this relatively simple analysis is that it neglects to consider the concept of sellable supply. Yes, Bitcoin has a protocol-defined limit and ETH does not, but the price today will be impacted by the amount of supply that is currently on the market, those coins which can theoretically be sold. Now, when it comes to both Bitcoin and Ether, we have seen a sustained fall in supply on exchanges. However, in the case of Bitcoin, the fall was about 15% since August last year, whereas ETH was 20%. So, why is this important? Well, if there's less supply on the exchanges, it means that there are fewer coins that are available to sell, and hence impact the price. The crypto that's taken off the exchange will most likely be hodled in cold storage or used as utility in the network. However, there is one important distinction to make between this off-exchange supply of Bitcoin and Ethereum, and that is how easy it is for that supply to make its way back to the exchange. In the case of Bitcoin, all that's really required is for those hodlers to access their cold storage and move the funds back to the exchange. There are no barriers to offload their coins should they wish to take their profit. However, when it comes to Ether, supply is a lot less fluid, and that is down to two main reasons. Ether locked in smart contracts, and Ether being staked in the ETH 2.0 deposit contract. Let's start with that first one, shall we? As mentioned earlier, there is insane demand for Ether to be used in DeFi protocols. This Ether is often locked in smart contracts and protocols as collateral where it earns a yield. Let's take a look at those funds. Here we have the total value locked, TVL, over at DeFi Pulse. As you can see, it's at all-time highs. From $15 billion at the beginning of the year to almost $40 billion at the time of shooting this video. How crazy is that? So if you've locked your ETH in a smart contract and it's earning you some pretty decent yield, then there is more of a disincentive for you to remove it and sell it. So sticky. However, there is one ETH smart contract that takes the sticky concept to the next level. That's because Ether locked in this smart contract cannot be withdrawn anytime soon. I am, of course, talking about the ETH 2.0 staking contract. This is the contract on the Beacon chain where ETH holders can stake their ETH in order to earn those staking rewards. However, unlike with other DeFi protocols, ETH locked in the staking contract cannot be withdrawn currently. That means that all the Ether that's being sent here won't be able to be brought back to the market anytime soon. Currently, there are over 3.2 million ETH locked in the deposit contract. This has been growing at a steady and consistent pace since the contract opened up last year. It also looks as if this trend is showing no signs of slowing down. So, we currently have over 3.2 million ETH that's been taken out of the market for the time being. ETH that won't be contributing to any sort of selling pressure anytime soon. If we hop on over to Glassnode, we can actually take a look at the percentage of all ETH supply that is currently held in smart contracts. We went from just over 10% in July of last year to almost 20% now. So it seems that from a supply perspective, ETH is more favorably positioned. However, there is one more supply factor that I think we need to touch on. One that will neuter that argument of ETH being an inflationary asset. Together with ETH 2.0, EIP 1559 is perhaps one of the hottest topics in the Ethereum community right now. For those that don't know what it is, it's an Ethereum improvement proposal that will change the way that users bid for transactions to be included in blocks. Basically, this upgrade would set a market rate of the gas fee required for block inclusion. This is called the base fee. Users can still pay the miners a tip if they wanted to get their transaction through much more quickly. So, what are the main benefits of this? Well, contrary to popular opinion, it won't actually reduce gas fees. What it does do, however, is that it makes gas fee management a lot more predictable. Important to clarify that. However, it's what this EIP does to the supply of Ether that is of most interest to hodlers. That is because it will see that the aforementioned base fee is burned, destroyed, and taken out of circulation. Given that gas is paid in ETH, it means ETH will be burned. So, the more that the Ethereum network is used, the more Ether will be burned and taken out of supply. In times like now, when network use is at all-time highs, it means that a lot of ETH is going to be burned. In fact, if network use is that extensive, then it's possible that the burn rate can almost completely neuter the inflationary component. So this means that ETH could theoretically have the same long-term scarcity argument as Bitcoin. However, instead of a protocol-defined limit, you have insane network use and ETH burns. Of course, there is a lot more to EIP 1559 than this, and I've left some docs in the description for you to peruse. Perhaps it should be a topic for one of my upcoming videos. It's time to wrap things up, folks. When it comes to the question of Bitcoin versus Ethereum, I feel as if I can approach it in an impartial manner. I hold both and have invested in them based on different theses. However, for the short to medium term, it does look like ETH has the upper hand. Its price is lower relative to its ATH, and new investors know this. I've also shown that institutional investors are beginning to pivot into alts. However, it's not that much of a leap of faith to allocate some of your institutional portfolio to ETH if you already hold Bitcoin. Then, of course, you just have to consider the immense utility demand on the Ethereum network right now. Despite how revolutionary Bitcoin is, its use case as a medium of exchange is on the downtrend. It's an asset held for investment purposes, and that's unlikely to change anytime soon. Finally, that supply shortage in the ETH markets is likely to have a sustained impact on the price. It's locked in smart contracts and cannot easily be sold. And of course, we cannot forget about that impending EIP upgrade that could possibly eliminate all inflation on the network. It could make ETH that rare digital platinum to rival Bitcoin's gold. Of course, there are always risks here. The gas fees are crippling and they are driving users to other ecosystems. You also have to consider that miners are not fans of EIP 1559 and ETH 2.0 could be delayed again and again. Or perhaps there's a new flood of Bitcoin institutional buying that comes from an unlikely source, one that I haven't seen coming. However, on the balance of probability, I do happen to think that ETH will be the better performer in the next few months. Now, you folks probably want to know where I think the price is going, am I right? Well, on the Bitcoin side, I think that we are well on our way to that 100k level by the summer. This is the level that's predicted by the stock to flow, and it's been doing a cracking job recently at mapping that price. You should also consider the $1.5 trillion Biden stimulus, which is likely to pump retail money into crypto. It's entirely likely that we could see Bitcoin at 150k by the end of the year, assuming we have similar S2F diversions that we've seen in previous bull cycles. Over on the ETH front, EIP 1559 is slated for a July release. I think the excitement around this update could supercharge the price above $5,000. And when the fee burns start to take hold and we roll closer to the next stage of ETH 2.0, this euphoria could power ETH to the 10k level by the end of the year. So, those are my predictions. But it's my opinion and I am not a financial advisor. I have mentioned that before, right? Well, that's it for my video, chaps and chapettes. I'm keen to hear from you fine people now. What do you think of my analysis? And which one are you more bullish for in the next 6 months? Fire those thoughts into the comments section. Then, while you're down there, I have a little secret to share with you. It's my socials page. Over here, you have links to all the places that you can follow me. These include my Twitter for my daily thoughts, my Insider Telegram channel for market analysis, my Instagram for memes and behind-the-scenes action, and the meat and potatoes, my email newsletter. It's my once-weekly look at everything we can expect in the coming week. I also give an overview of my personal portfolio as well as some hot coin tips. So yes, check out all that good stuff below. Oh, and if you'd like to help support the channel, then don't forget to pop a visit to my merch store. You can get a design just like this one, as well as many others. Now, given that you've made it this far, I assume you've enjoyed it. Well, let YouTube know how you feel by turning that like button blue. Don't forget to hit that subscribe button as well and ping that bell for good measure. Thank you so much for watching. This guy will be seeing you guys very soon.